Hello everybody, Matt from Invexor Trade. Just we're going to do a quick video for you. So we're going to cover DAX in the last couple of days really. A minute 5 chart. We're just going to cover loads of the lessons which we should be learning and reviewing and just forming part of our toolkit, part of our trading sessions each time. Just things to talk about. So I'm going to cover RSI, some chart patterns, some Fibonacci, just to give you a really quick overview of what we're doing and what we're looking for. So to start off with, I think we touched upon this today. We had a bear flag here. This is DAX minute 5. So effectively with a bear flag, what you look for is a fairly sharp decline. Okay, so price comes down and then it's consolidating. So it's bouncing between this range. At that moment in time, you don't necessarily know that it's a bear flag. So some of the key points I look for, as soon as you get this drop down here, okay, I've got 1 point comes up. Now at this point, you don't know whether that's going to just rally on up. Okay, price comes up. So you've got this 1.2 point, price comes up towards the double top here. But at that moment, all you've got to do is right click, clone it. And this first point there, just literally place it on top, very, very close. So what you're going to see is the price comes down. Okay, before any of this happens, you've got 0.1, 0.2, okay? So you need another point. So as soon as you get this point and it bounces, you've got that horizontal, slight increase actually from horizontal angled up and sideways. So just literally double click, so right click, clone it, put it to the top of the first point. Then you know, okay, at this point, let me just say, you still don't know whether it's going to go straight on up, but it's a high probability trade. So sharp move down, 1, 2, 3, can do this. So this is technically an A, B, and a C. It can do an A, B, C, D, E, but all you would do is extend those lines out. Okay, so your entry point would be, let me put a short position. This is on trading view. You can see here your stop loss needs to be just above, give it 20, 30 pips, say, above that line. Target you can use again. You could clone this. Okay, you clone that line. A couple of ways of getting the target, and it comes down. You're getting 158 pip move. That's just one way of getting the target by literally cloning. The other way, which obviously I'm a fan of, using Fibonacci. Okay, putting the 0 here, the 100 to the bottom. So bottom of, if we don't know that that's a wave 1 yet, we'll call it a wave 1, or it's an A. This is a 2, or it's a B, and this is a 3 or a C at this stage. The target which you're looking for is quite simply 1618 to the 178. Okay, and this is probably a sub 3, a sub wave 3. I would expect. I'm thinking this is a wave 1, a wave 2, sub 3, sub 4, and then we come down 1, 2, big 3 down. But you don't need to know that. If your target is 1618, it comes to here and it's perfect. So that's the other way of doing it. You could put your, that's exactly the length of the pole from the first place, and then you get a region around there. But the Fibonacci works more likely than the flag, and it is roughly, you still gain from there 370, 206, 165 pip move. £2 a pip is £330, one trade for the day. So there's a chart pattern that is bear flag. I think we saw that earlier on the minute 1. I think it might have actually been Dow Jones last night. If we go to Dow Jones, which is Wall Street, US 30, we have a quick look at this last night's 9th. Here it is. So when we had this sharp decline, you'll see it's a bit steeper. So it's not, if they're flat, you don't really like the look of that. But when you've got a decent move down, okay, so the move came down there. We then got a huge move in the end off that. But again, just playing it safe. You could look for the 261, but even if I put it there, you would have taken your profit, even if your profit was set to 161. I mean, the 261's down there. Can you see? And then it bounces. You've got the 1618 is so 29983. You would have entered here at 30085. So again, nearly 150 pip move just off that bear flag. So chart pattern's really powerful. always look, they're called continuation patterns. So you get a sharp move, price consolidates, and you're not sure whether it's going to shoot up or drop down, and then it goes down. So have a look, get used to those, get familiar with bear flags, bull flags, falling wedges, rising wedges, symmetrical triangles are really, really powerful. I'm just going to cover RSI 5-minute 5 DAX, the buy side again. So I'll actually show you in a chart pattern. You can see how we can combine the tools. So this is a falling wedge pattern. Come out from there. And then you get the breakout, which obviously people buy there. But you'll see RSI dropped. Normally we stay in minus, under 19, but generally it's lower than 12 for the first move. That's really what gets your ears lifted. Price came down, price came up. Okay, so this was the low. This level here was the low. So I'll zoom in, make that clearer for you. This was the low. RSI made a low. At that point, you put a mark in the sand. You say, right, well, RSI made a really big low there. So if price drops below that level, okay, and RSI's made a higher low, then we're in business. So it came back up again. So you would potentially, worst case scenario, you would have entered when it came back out. So you would have entered at 13,217. Okay, the way we're trading it is even if it drops, it's within 50 pips. So you'd have entered, the low was 197, which is only 20 pips away. So you were fine. Even if you entered at the second stage, you were fine. You were okay. Price then obviously moved from where did we say we would have got in there? That second dip, 217, and it goes up to 456. So it's 230 pip move. Absolutely lovely. Thank you very much. And again, combining the RSI, when you've got a falling wedge and an RSI divergence are end instructions. So a falling wedge will become bullish, and obviously it's supported by the bullish divergence, so it's confidence to enter decent big trades. Likewise, here we have a look for the sell. Okay, bring that down there. So you can see at this point, RSI made its peak. Okay, so RSI was 93. Huge level. So again, your ears perk up. Had a bit of a dip, came back up. What was the price? To say 260, and it went to 290. So again, with a 50-point stop loss, even that spike there, you would have entered here. Okay, well, worst case probably there. So 260, price went down to 156. So it's a 104 pip move purely from there. Again, it's always better when the double move above RSI for the sell comes over 90. 88 is a key level as well. But again, even if you entered, you could see, I mean, here price didn't really go much higher, but you could argue it was flat and RSI got weaker. So worst case scenario, you entered at 260, and then you went to 155. So really good move again. It's definitely, you need to be looking for the sells as well as the buys. Clearly, we're moving average 9 on the daily, even hourly 1. Price is above that. That means the trend is up. So you need to be looking to buy dips rather than trying to sell. But again, it just shows you that it can work as long as the first move is in an extreme area. So what you might want to do is go back and have a look and say, right, well, I don't want to buy until the first drop is below, say, 14 or 12 for the first drop, and only when the second drop comes below 19 will I look. The next one we'll look, I'm going to clear the chart off. Next one thing I want to look at for you is when we've got a pullback after a 5-wave move up. So here we had a 1, a 2, a 3, a 4, and a 5 up, Elliott wave. So once you got a 5-wave up, we look for the 61.8. So you draw from the low to the high. So this price nothing had happened. You put the 0 at the top, 100 at the bottom. Look for the 61.8 to 90, and then you start to look to enter as long as you've got a signal. So just to remind you where we were here, we had price was coming down. We had a falling wedge. We have divergence. So again, we're combining our toolkits. So now all of a sudden we're entering 61.8 to 90 with a falling wedge with RSI divergence. So we're entering. Okay, again, that move 61.8 was 206. your stop loss would have been just below the low, so 50, yeah, about 50 pips, and it gave you 455, so 240 pip move, huge. Okay, so that's the Fibonacci looking for the retrace. So 5-wave move up, look for 3 back, even if it's a corrective cycle like that. We're then going to look for our targets. So let me just delete this move for you. There's 2 ways of getting our targets. We use Fibonacci retracement, but with the extension. We've added our tools on. So you do 100% at that previous peak, 0% at the low, and we're looking. This is called the slingshot technique, if you remember. So the slingshot, we'll put a 61.8 up there, okay? Then we'll use our Fibonacci expansion. Sometimes they call it extension, but I would refer to this as expansion. And then we'll literally join the peak, so there, come back. And again, when you're combining these 2 Fibonacci's, you can, for probability area, you just join the 2. So the 261 and 1618. So can you see that? That brings it in beautifully right to the top. I'm going to just talk you through that again one more time. So here we've identified fairly decent bounce off the low, and it was a 1, 2, 3, 4, 5 up, and then this is like probably an A, double B for correction, and then a C leg down. But what we're doing is we're looking, as soon as we've got that 5-wave move up from here to the low, we're putting the 0 on the top and 100 at the bottom. Okay. Then we're looking to place, we don't know when it's going to happen, but we put our price target 61.8 to 90. We're going to look for a bounce from that region. It's going to bounce, it's going to come. If it drops and it fails, then we're having our stop loss just below this low, because that a wave 2 can't go beyond that. So we identified the area, so we say great, we buy it. Now we're going to flip that fib, so we put 0 at the bottom, 100 at the top. Okay, bring that up. So 0 goes to the bottom. So what we're effectively saying, this is a wave 1. At this point we don't know, but we think that's a wave 1 up. And a wave 2 down, so wave 2, 0 goes there, and our target is 2618. This is the slingshot. So you imagine it's like a catapult. You pull it back and bang, fire it off. We're then going to combine it. This is purely to create probability areas. We're going to add in our expansion, Fibonacci. So again, 0 bottom. First point is at the top of the move after the 5 waves. Bottom is on the 0, and then all of a sudden we've got a 1618 and a 2618. So all I do is just create a box, and it will be there. Okay, so I will be buying the 61.8 to 90 retrace. Okay. And I will be taking target, I call it target area or total profit 1. You can hold it. You could potentially cash out at 50 pips. Depends what your strategy is. If your strategy is on do 30 pips a day, 50 pips a day, then you just take your total profit, 30 pips, 50 pips, and take your money and run. Straightforward. But that's it, okay? So you can see it there. You're buying the 61.8 to 90, and then your target, your total profit area, is the combination of Fibonacci expansion and Fibonacci extension. You're looking for the slingshot 261.8, and you're looking for the expansion of 161.8. You just create a box for the probability area to go there, and it gives you what that's effectively giving you is your entry area, your total profit area, and your risk management. So your stop loss would be at the low of this point here. It cannot go beyond that point. So if this probably works, in my experience, probably works 7, 8 times, maybe 9 times out of 10, buying the 61.8 to 90. Of course, you need to remember what trend are you in. If you're in an uptrend and the market's moving up, then you're going to find that this probability is a lot higher because buyers are in control, so they are buying aggressively every dip. If the market is going down, prices below moving average 9 on daily and hourly 1, this is going to be less likely, okay? So in a buying market, you want to be buying 61.8 to 90, okay? And you want to be buying the RSI divergence. In a selling market, you want to sell the RSI divergence and you want to sell the 61.8 to 90. So in a buyer's market, you look for buy. In a seller's market, you look for sell. If you're doing counter trend trading, it's more dangerous. one of the only kind of high probability ways I know of doing that is from RSI divergence, and that's why we teach it, that's why we use it. I'm just going to show you as well, obviously the chart patterns there are a lot, and we covered this one the other day, okay? So if I show you, this is called an inverted head and shoulders. This is going to be one shoulder, okay? This is going to be a head, and this is the other shoulder. Now what you get is you get a neckline. So the neckline's obviously got to be fairly flat, like that. So it's fairly flat. The shoulders cannot come below the head. So you've got a head. The head sticks out, same as a head and shoulders pattern and an inverse head and shoulders pattern. You need to know these. You've got both shoulders need to be lower than the head. Okay. Then at the bottom, cutting across, you've got the neckline. So this is inverted because it's upside down. Which is very powerful. Again, you can see it. We identify that pattern in the first target. You can use these tools again to measure. Price range, you use the top of the head to the neckline. It's roughly there, 132 pips. You then, easiest way I guess is to clone that, drag that up. Okay, put it at the bottom, and then you can see it gives you an approximate target up here. So 132 pips. You cut the ways of entering, and I'll show you. Most people say, oh, we wait for it to break the neckline and get in, and that's a safe way. That would still give you the 130 pip moves in one move, and it's bullish, so it's very quickly. The other way, we've just talked about Fibonacci's. So what you can do, exactly the same in a buyer's market. Price comes down. Let me click. No, we'll leave that on. Again, price comes up here, and you're looking for a 3-wave move down. You mark out 61.8 to 90. Okay, that's it. So we're going to say this is arguably at this point right shoulder, and you buy zone because it's 61.8.90, and we're in an up market. I then, as you probably hopefully this is sinking in and you can say this yourselves well, but then we put the 100 on the top, we put the 0 there, and again this is a different completely, you know, we covered this. Let's have a quick look. We put the 261 there, we used the expansion, and I'm just working it backwards on purpose for you so you can actually see that when you combine these, you know, and I encourage you to go back and do it. You've now got a head and shoulders pattern, which we could see. You've then got the Fibonacci targets, you've got the buy, you've got the target area, you've got falling wedge, you've got RSI divergence. So using all these tools can really help you to have the confidence to enter and hold and make big money, you know, throughout it. Wherever you're looking, whether you go 61.8 to 90, slingshots, you know, if we do it on the sell, let's have a quick look again. So this is wave 1 up, come back up. So you put your doing it in reverse now. So we'd want our box 61.8 to 90. We'd be selling there, okay. Stop loss would be above this high. So again, you're talking, say you got in at the earliest point, 376. You've got a bit of move there. You'd have your stop loss above there, but really you wouldn't be entering until you can see the divergence. I would say using again awesome oscillator. There's some divergence which crept in there to suggest that the move's gone down because the peak was actually here, but price has gone up. It's then sold straight back down. So I think actually it should probably be there if you look at those highs. Price came up and smacked back down. So we're looking for sells now, okay? So trend has changed. We're looking for sells, 61.8 to 90. We've gotten up here, stop loss above that top. So you wouldn't have been taken out, you'd be absolutely fine. We'll then move our fibs around. Okay. And if I put wave 1 down, we come down to 1618. So, I mean, it actually ran on as well. Combine our Fibonacci levels. You would have got 1618 was down here, so it actually sorry, there it is. First target 100 and 1618 there. First target 1, first target 2, 261, 168. put that there. So you would have missed that slightly by 157, so it's 11 pips out. But again, if you've entered up here, even if you entered at the 61.8, which I think was the green box there, 377, and it eventually went down to 157, so over 200 pip move again. You know, which is they're absolutely huge amounts. And I want you to go back through and start having a look at all of these, because there really are some powerful tools. You've just got to get used to spotting them, seeing them, watching them develop. Next one I wanted to show you just really quickly was the range, and then using support and resistance. If I come here, I can see price shot up there and it's sold off aggressively, came back up, sold, came back up, sold. I've got a few reference points here. Okay, so I can create effectively a zone. Okay, I'll probably bring that one down to this wick here. I could also add a horizontal in between just to start seeing the main areas, you know, what's causing. And what you'll see is up to this point, so I'll put a vertical just to try and break it for you there, till it broke out. At this point, every time, you know, it's bouncing between the two. You know, we could put potentially another line here because that offered some support. So what you've suddenly got now is you've got a range. Now, price has been trying to break out. When it breaks out, it then comes back to test the support. So if I focus purely on this black line at the moment, this was, because this is kind of overshoot levels, these. This line was huge, massively important. Again, we can put, just to help you visualize, and I do this on my charts as well, most days when I'm setting up, see what's going to happen. I just want to start looking at how many times is it rejected, because what we've probably got is big sellers coming in here as well, thinking the market's going to turn and come all the way down here. So we're getting some big sells. So before the market can truly run off, if it wants to go up, price needs to come back down and close any shorts which are here. So you can imagine, if I just zoom back out, go to minute 30, you know, at this point, the price has come down. This was huge sellers area before. Can you see? Its price comes down. So what you're expecting actually is when the price came back up to these levels, you're expecting sellers to be smacking the price back down, expecting a huge retrace because it had just rallied from 11.3 up to 13.3. So 2,000, I think, 50% retrace. You know, we might need to come back down to these levels. You can see where they're probably more sellers. So they get big sells in here and it doesn't. It just starts racing up. So what they need to do is come back down and it creates almost what was resistance is now support. And it acts, can you see, as a support here. This one dips back down here, which could be, you know, around these levels. Bounces up. And then it's still struggling to really take off. So there's a couple of options here. There's a good chance that the market does go up. There's still a gap up here. But it can't go up until it closes these shorts. So what I would be looking for, again, really, you want to see if it's going to go up. If you want to see these get closed, and then really the direction of travel should be nice and strong. If it's not, then we've got a potential. This is a false breakout, and actually the market is going to come back down to these levels before it takes off. So this is really key. It works on any time frame. You just go back through, look at it. You want to have a look at where they've been caught or where prices struggled, and then have a look at it for resistance. If I clear that completely off again, just say where at these points, selling. Okay, so before any of this price has happened at the top, you could just say, well, this is key. Okay, so you can draw it across your chart, and you can say, well, that's key. And then price, before it really raises off, it has to come back. So even now I can say, right, well, we've kind of got a new range, and I'll extend that outwards. So now I can say, right, well, you know, give me some targets. Give me some base, some structure, some supports. Where are we? This is where we are. So now you can say, right, well, if this level starts to break, this was a kind of key level, then there's a really good chance we're going to test these previous areas, because they've obviously held for a reason. But again, you can have a look And again, just to show you why these areas are so important, these areas will clearly, just take that across. You know, at this point, market selling hard, comes up, sell, breaks down. That's almost a head and shoulders pattern. Comes down, bang, sell, bang, sell. So huge sellers are probably at these areas, and that's why these areas need to close it. So it's a constant battle of closing positions down and running the market the way they want it. So always look for resistance areas, even if you're just using these and chart patterns. Here, for instance, you just see we had some nice movement there on DAX, taking it again back below the moving average 9. So this is on the minute 5 chart. We're going to start looking to say, right, well, you know, in order for them to drop the market, where did they need to go to today? And I know I'll just show you this, bringing in the chart pattern again. We were talking about this obviously in the Slack group. Okay, if I just take that off, you will see that at this point, they would be looking potentially here to buy as a 61.8. So that all of a sudden becomes huge support, and you can see it. You know, they could have been buying there all the way across. You say, right, where could they be buying? 61.8 to 90, expecting it up, and didn't it fell away? You'll then see, in order for them to continue any move down, where they've been caught today, they want to go and close that ideally. They want to close it as soon as possible. So price then comes up, and if I zoom in on the minute 1, you'll see this exactly. So this was the area, and when you come up, they would have been buying here, big spike, come down, buy, and then if you look, this is a minute 1 chart, so this is probably, that was green was their last close. Okay, so that last green candle was where the last, what I would call the gap. Put a horizontal ray across the close of the green candle. We've got 3, 2, 6, and then you'll see. So ideally, you want to see seconds. You don't get on TradingView unless you pay for it. But it's 325.3, so it's 0.7 of a pip away. I'd imagine it's probably closed somewhere within that, and if you use your broker, you'll be able to see whether it's the spread or whatever. But again, these wicks at the top of these candles gave it away. Price came up, closed, bang, gone. So that's just really quick overview for you tonight, just to cover some of the key points we've been using. Make sure you're looking using the RSI buy, RSI sell. Of course, trying to find out which market you're in first on the hourly and daily. Are you in up market, down market? Use your Fibonacci retrace for entry. Use Fibonacci extension for target. Use chart patterns, so bear flags, bull flags. They're continuation patterns. Symmetrical triangles, they can break both ways. Falling wedges are normally very bullish as long as the RSI divergence is in place. Rising wedges, generally bearish, but you need the divergence of awesome oscillator to confirm that, because it's an ending diagonal, same as a falling wedge. Head and shoulders pattern, inverted head and shoulders pattern. Get used to knowing those. Combine your toolkit so you can use it all together. If you find a few of them that happen at the same time, falling wedge, RSI divergence, 61.8 region, have the confidence, trade it, make money, use your risk management, and you'll do well with it. Okay, so that's me done just really quickly, just to bring those tools together for you, and catch up with you soon.